Hi, it's Pat Fitzgerald with Academy Mortgage. Today we're going to talk about what is a non-QM loan. And I know a lot of you have heard about this term in the last couple of years, and I just wanted to go over some of the details with it, and maybe some of the things that I'm going to say will help you think about perhaps some of your clients that really need this type of a loan. So basically, a non-QM loan is a loan for people with uneven incomes, generally for self-employed and straight commission folks, also business owners that don't like to show a lot of income. Well, that could be a realtor, a CPA, people that get bonuses, entertainers, people like that. Largely for people that are paid on 1099s versus W-2s. That takes in a lot of people. So non-QM does not conform to U.S. government Fannie Mae or Freddie Mac standards, nor do they have to live by those rules. Non-QM loans aren't backed by the government, and so there's no involvement there. Non-QM loans are backed generally by investment firms and large insurance companies and things like that. So how does it really work? First of all, employment is not always required. What the non-QM loan underwriter wants to see is income coming in over the last 12 to 24 months. And the way they do that is with the client's bank statements. So the client is always going to have to be prepared to provide 12 to 24 months bank statements. Why the big variance? Well, the client will get a slightly better interest rate if they can produce income over a 24-month period rather than a 12-month period. So bottom line is then they can take a look at the incomes that are coming in. They count this income without asking necessarily where did it come from. They also take a look at the assets of the client. That also makes the loan look better. So the underwriters analyze that income coming in, and that's how they come up with the capability of the borrower and do they really want to lend them the money. Credit scores must be almost always at least 660 or better. Better will get them slightly better rate. Minimum down payment on a non-QM loan is always 10%. They can get a slightly better rate by putting down 20%. So bottom line is this, the non-QM loan is just a completely different set of rules for everything. There's never any PMI added to a non-QM loan. We can also use these non-QM loans for non-warrantable condos down at the coast or on a lake. And a lot of people find that very intriguing. They will not, however, do rural properties. No farms, no ranches, and things like that. Mostly no evidence of income is gathered other than what shows on that bank statement. Almost always no tax returns are gathered. Why? Because with these people that get these big write-offs, they're going to be writing off things that are going to reflect in a reduced income. The other thing that I want you to know is it doesn't really take any longer to get one of these loans than anything else. You can use these to buy a principal residence as well as an investment property. And there's a few other rules like that prevail. But if you have any questions on these loans, I'll be happy to answer them for you. I always tell everybody it doesn't cost a penny to talk. So call me right now. I'm at 210-215-4400. That's 210-215-4400. Thanks.